Welcome to Market Call. Thanks for joining us today. I'm Morella Fernandez. Darren Sissons on the show, partner portfolio manager at Campbell, Lee and Ross Investment Management, taking your questions on global and technology stocks. Here's how to reach us today. Call us toll free, 1-855-326-6266. You could email your questions today as well. Market Call at bnnbloomberg.ca. Darren, thanks for coming in. Good to see you.
Good to see you.
Let's start by talking about Donald Trump now wanting to fire a federal governor, and some are questioning whether or not that means more political pressure to come on the Federal Reserve. What are your thoughts on this move and what it means?
Wow, easy questions just to start, huh?
Exactly.
Okay, I would start by saying there's just a lot of volatility throughout the whole year. Right? There really has been, everything from the Epstein files, the bombing of Iran, even today, the Cracker Barrel logo. Like, what is all this about? But I think when you think about the Fed, I don't think, unless I misunderstand the tea leaves, that Donald Trump can actually legally fire her. So that's the first thing. She's engaged legal counsel, and this is going to get very messy. Would obviously get solved through the courts. But the question becomes, he's really, from my visibility, he's really targeting what he sees as a weak link to put pressure on the Federal Reserve to effectively lower interest rates, because that's what he wants. Well, when we've got the stock market at record highs, there's a disconnect between what's happening in the markets, what's happening in the economy, and why we need lower interest rates. Typically, you cut interest rates because the economy is starting to weaken. We are seeing, obviously, areas of the economy weakening, some job losses, obviously bankruptcy spikes, corporate margins and so forth coming down, but more so outside the US. So the question becomes, will a September interest rate cut probably happen because of pressure from the president, or is it actually really being driven by the over-financialization of the US market, which really is heavily dependent on the stock market getting ever stronger so that everyone feels richer and wealthier? Because if the stock market corrects, the wealth effect in reverse is going to be very meaningful. And I think that's really why Donald Trump is really doing what he's doing. The fact that he's picked Cook, she just happened to be a weak chink in the armor. But we've still got to wait to see whether or not there is a rate cut decision. So I think that's generally how I see that whole dynamic. It's not just the president just waking up one day and saying, okay, I'm going to fire that girl because she did something that I don't agree with.
What's interesting is that we heard from Jerome Powell last week, and he did open the door to a rate cut. The first time he's kind of said, beyond we're looking at the data, he has set the ground for a rate cut in September. We don't know what that will look like. But it also allows Donald Trump to say, I got us a rate cut, right? When one does come about, because he's been pushing for it so hard. I'm just wondering what you see that rate cut being, sort of a quarter of basis point. Where do you see the 25 basis point cut, a quarter, or more than that?
I suppose what I really see is, yes, we could see a 25 basis point cut in the US. I don't see more, because I just don't think the conditions really warrant it. Like, until you start to see, well, let's step back. Rate cuts typically occur when there is an economic challenge, like the onset of the global financial crisis in 2008, 2009, or you see significant deterioration in the labor market, the consumer, inflation is falling significantly. Inflation is still above headline targets, and that is really being created by the tariff war. So, the inflation could be retracted if the tariffs are taken off the table, but that's not on the agenda. So you've got this situation where you've got a push and a pull, and he wants a rate cut. We could quite easily see it if tariff inflation gets embedded, that there will be a need for actually raise interest rates. So I think this whole rate cut decision, yes, I think it happens, but there's no guarantee that we're not going to see higher rates here.
Got it. Okay, we're going to take a quick break. We'll line up some phone calls for Darren Sissons of Campbell, Lee and Ross Investment Management. He's here to take your questions today on global and technology stocks. Here's how to reach us. We're back in a moment. Welcome back. Thanks for joining us here on Market Call. Let's go to an email from Val. Val says, wondering if it's time to sell Nvidia. Nvidia has been climbing up almost to its record point of 183 plus. And a lot of, there we go, 180, 113 at this point. Some people are trimming. We've seen some pullback in tech. They report this week, of course, tomorrow. So what is your take on whether it's time to trim back on Nvidia?
Okay, so I think there's a couple of things. Firstly, I think the AI hype has just overextended significantly so. In fact, it's highly reminiscent of the dot-com era in 2000. That's how bad it is. So I think one metric would be Nvidia has got a larger market capitalization than the entire market capitalization of France and the UK. That just makes no sense. So bigger than its market cap's bigger than the Canadian market, the Australian market. Like that in and of itself is nonsense. Right? So I think that's the first thing. Having said that, if you own it, you've made serious money and you're playing with the house's money. So I would say you never go bankrupt trimming a winner. And you should, as a discipline, do that periodically. I think the broader question on Nvidia is it's only really one component of the AI story. It's just the computing power. What about all the predictive models and that? That's all going to come from software. So really, how can one component have so much economics of the thesis, and everything else is somewhat lagging? So for example, predictive health. What could tell you to get cancer? That's going to be a software-driven tool. It's not going to be coming from a computer. So yeah, I just think Nvidia is very expensive, and where we have it in our model, for example, when new clients on board, we tend to trim it.
Okay,
so
and there might be other spaces that will benefit from AI, you're saying, where you could get in at a reasonable price and watch that stock grow.
Oh, I think there's a number of silos that you can definitely participate in, but just continue playing the same theme over and over again and pushing it ever higher. It's a recipe for disaster.
Got it. Okay, let's go to the phone calls. David on the line today from Toronto. Hi, David.
Yes, hello. Darren, I would like to hear your thoughts on United Health. Thanks very much. I'll hang up and listen.
Okay, thank you for the question. United Health has had a number of challenges over the last year. The whole space, healthcare pharma pushed down quite a bit. United Health beginning to claw its way back. What's your take on the sector first, if you don't mind, and then United Health specifically?
Yeah, I think that's very good. So obviously Robert Kennedy and his crusade against the healthcare segment, really to lower costs. I think today he announced he wants to get rid of the COVID vaccine. And regardless of how you feel about that whole positioning, that is a headwind that is pushing down prices. Then you've also got, a couple of weeks ago, we had the executive order on drug pricing, which also was a depressor for obviously the opportunities for particularly non-US companies, but also pharma companies, biotech, et cetera. But that contagion also spread into medtech. So I think we're at a point now where just generally broad healthcare is probably the cheapest it's been from an entry level point of view than been a very long time. Growth is not going to go away. People are still going to get sick. People are still going to need therapies. There's going to be new and innovative therapies. And if the US is going to cut back and curtail its R&D spend, then other parts of the world are going to continue to advance there. And there will be a lag relative to the US competitiveness in that space. And I think that will be recognised. In terms of United Health, I generally tend to take the view that there's never only one cockroach. Obviously, we had the CEO issue, then we had the issue fairly recently. As you can see, the gap down. So I probably wouldn't buy it here. I think you can watch it, but I think there are better opportunities in the broader healthcare space to look at. And
are you saying you would go abroad, perhaps, to look in this space because other companies, international companies, are going to skip ahead of the U.S.?
Well, I think one of the interesting things that has largely gone unnoticed is the Chinese have an island that has 100,000 people that are terminally ill, and provided they provide their data, they get free healthcare. And that data is then being used as predictive to help advance the Chinese medical development efforts. So the Europeans are obviously going to, in some shape or form, try to participate there, the Chinese. And if the US can't participate, there's big opportunities. So there's a lot of downside for the current strategies that are being advanced by, particularly by Robert Kennedy.
Okay, let's go back to the phone lines. And Chris is on the line. He's in Victoria, BC. Hi, Chris.
Hi, Marella and Darren. Great to see you back on the show. Darren, I bought British American Tobacco on your recommendation. It's got to be at least a year, maybe a year and a half ago, and I've done really well with it. The 5-year chart is sort of just like a skier going up a steep slope, and I'm wondering if do you still think it's worth holding? I guess essentially a buy, hold, or sell. And if it is a sell, if you'd have an alternative, I will just say that I listened to a podcast once, and I believe it was Rothman's in Canada before they went private for an extended period of time with their very high dividend. The total return beat the TSX for many consecutive years. So there definitely is a place sometimes for these sin stocks. Thank you so much.
Okay, thank you for the question. Is this a stock you still like?
Yeah, so we own it in the portfolio. So yes, it has had a very big run, but I think if you go back a little bit further, what you see is it's sold off on really efforts, ESG efforts. And then, we're starting to see some of that being rolled back across renewables, across everything. So, but has a very sustainable dividend. It's not obviously done very well this year. I don't see any downside in trimming something when you're up, 70%? Probably on a total return basis, you'll be up 80% by holding that stock this year, 80-90%. So there's nothing wrong with taking trimming some winners here. But the problem you're going to have is if you were to completely sell it, you're probably sitting on a dividend on cost of about 10%. 10 to 12%. So the longer you've held in names like this, the harder it becomes to sell. And you've used them perhaps as more of a total return story and a cash driver for your portfolio. So yes, take some money by all means, but recognise it's a winner, and it was oversold for the last few years anyway.
Got it. Okay, let's take a quick break. We're going to be back with Darren Sissons of Campbell, Lee and Ross Investment Management. He's taking your questions on global and technology stocks. We're back in a moment. Stay tuned. Welcome back to Market Call. Thanks for joining us today. Let's go to Derek on the line. He's holding in Chilliwack, BC. Hi, Derek.
Oh, hi, guys. Great show. I'd like Darren's opinion on Salesforce. It's come down quite a bit lately. I'm wondering, is this a good entry point?
Okay, Salesforce at 244.08, down 1.5% just today. Do you like Salesforce? Did you guys invest in this?
Yeah. So I would rank Salesforce, Adobe, all of those kinds of companies really as the net losers relative to the AI thematic. The view is effectively that large cap vendors or software vendors are somewhat dead. And AI is going to take over and displace the world.
Sure.
Right. So you look here in Canada, Constellation Software, for example, very, very highly priced company. That hasn't been hit. So there are some names that have been hit and some names that have not. Salesforce is a very well-run company. Its growth has slowed somewhat in the last few years. But at these levels, I look and I think, if it falls much further, it's probably something we'd start to do some serious work on, because I think longer term, this is actually a very interesting story. So at these levels, I would say start to get out your pencil and start doing some numbers.
Got it. Okay, let's go back to the phone lines. Mark on the line from Cochrane. Hi, Mark.
Hi, how are you?
I'm good. How are you?
Good. Darren, I'd like your opinion on AltaGas. It's been doing well lately, but the past 2 days it's down almost $2. And I'm wondering on no news, your take on it, and do you own it? Thank you. Hang up and listen. Appreciate it. Thanks.
Thank you for the question. We'll pull up AltaGas here at $40.64 today, so down 2% almost on the day. Tell me about AltaGas.
Yeah, so we have a few of the prefs. I think we have some bonds as well. We don't actually own AltaGas itself, but I think it's a fairly we'd have a relatively positive outlook in the current environment. Something moving down 2%, it could be a large seller. I don't think there's any bad news. I think this is the kind of name that would be appropriate for dividend-focused investors that want to fund their retirement. If you're looking for significant growth over time, you're probably not going to get it. Obviously, since January, some of the big uplift has largely come on the back of the assumption that AI will drive lots of energy demand. Now, we saw that trend in 2000. .com was going to do the same thing, and ultimately it proved not to be the case. And remember, when you're bringing on new generation capacity, it takes a long period of time to get it up and running. You got the permitting. So I think we're going to find in some shape that the energy demand coming from AI is probably not going to be as high as expectations count. But that aside, I think AltaGas is a solid company for a dividend-focused portfolio.
Got it. Okay. Let's move on to an email from Doug. Doug says, what is your opinion of KLA Corp? We'll pull that up in a second and talk about that. But do you invest in KLA? Have you invested in KLA?
KLA Teamcore. So KLA is effectively a yield management tool used in the semiconductor space. So if you look at the chart, it's been very good.
Okay.
The challenge is a lot of the larger cap names in the semi-capital space, and obviously in the semiconductor space, they've become part of ETF allocations. So that has led to a non-cyclical performance of the industry. But if you compare it to, say, names that are not included in the indexes, like a ticker would be KLIC, Kulicke & Soffa, that company has currently had a very deep sell-off, and it is reflective of a weaker cycle. So I would say you might want to look at Click as opposed to Clack.
Got it. Okay.
Right.
Doug, I hope that helps you out. Let's move on to Tariver. He is calling us today with his question from Sierra Vista, I believe. Hi, how are you?
Hi, thank you, Marilla, and great to see you back, Mr. Sissons. My question is on Applied Materials. They supply also to the semiconductor space. The thing is, back in February 2024, you had said if the price pulled back, you might be interested in buying. The price has pulled back from then. What are your thoughts? And secondly, this China tariff, all this stuff, how is that impacting Applied Materials and other semiconductor stocks? Thank you.
Okay, so they have the input for the semiconductors, I guess, is what it looks like, and they're at 164.48. I don't know how long ago you were looking at it and what it was around at that point, but it has had a dip. Yeah. Are you interested these days?
So, so it's a broader offering than Clack, and obviously much broader than Clack, which I just mentioned previously. So, look, this is probably this and Tokyo Electron probably have the broadest semiconductor equipment offering.
Okay.
Lam Research is obviously there. And I think that as you're coming down, I think a lot of that is the political containment in China and the fact that the Chinese can't buy certain products from the capital equipment market. So I do like the space, but what always troubles me is that large names like Applied Materials, Lam Research, and Clack, for example, are part of the ETFs, and that's just $1 into an ETF just is buy automatically. There's no discipline around whether something should be bought or not. So I would like to see more of a cyclicality forming in the semi names for me to get really interested. Yes, we saw in April it was a nice rise, but then look at the cyclicality, the volatility. I don't like that. I want to buy when it's very inexpensive, hold it for a couple of years and sell. This to me is a trading sector, not an owning sector.
Got it. Okay, let's take another quick break. We're going to have a look at Darren's past picks when we come back. Stay tuned. Joining us. Let's go to past picks from Darren. At the time, he chose Accenture on the New York Stock Exchange, $318.68 US at the time. So this was August 6th of last year. Now 256.37, so a 19% return drop, 18% total return drop. This is essentially a consulting company. You were mentioning they run some programs as well. What has happened here? Why are they losing ground? They've been losing ground, I guess, since the start of the year.
Yeah, so, again, this is very much the story around AI is going to take over the world. So, they do consulting, obviously, but is IT consulting going to get displaced by AI? Are the models sufficient to be able to facilitate that? This is the same thing, the same trend that you're seeing with Adobe, with Salesforce. So you either believe that AI is going to completely destroy this business, or significantly so, or it's on sale. So I'm of the view that this is a complete rational exuberation on the AI belief. But the trend is your friend, so you make money when you buy, not when you sell. So we've owned this for a while, so we're deep in the money.
And you're staying in it. You think there's a turnaround a bit, at least a little bit here.
At these levels, we'll wait and see what happens in September when everyone goes back, when the pros go back to school from the holidays. If we see a sell-off, we'd definitely be buying some more.
Got it. Okay, let's get to your next pick from August 6th last year. Crombie REIT on the TSX. They do retail, office, mixed spaces as well. 13,880 at the time when you recommended it, up to 1504 today. Return 9% up and a total return of 16% up. REIT spaces right now, generally, how are they looking? We talk about office space being a little bit thin. People aren't coming back to the office the way we thought they would faster. Retail also sometimes can be a little bit hard right now. In that space, people are going online. So where do you stand on REITs and Crombie specifically? So
remember, Crombie was spun out of the Sobey family, right? So a huge portion of the footprint is the Sobey family. Then you've got governments, large businesses, totals around about 90% of the footprint. So the exposure to the underlying general economy is about 10%. We've also got an environment where real estate prices are coming down, so that would facilitate attractive acquisitions. And then you've also got an interest rate environment which, if it declines, would be beneficial to the sector. So again, this is the type of name that you would put in a dividend-focused portfolio where people are looking for safe and steady, sustainable dividends with some growth. And that's really what this name is. So, yeah.
So if you want the yield for it, you stay on, and perhaps there's some growth down the line as it picks things up in a lower interest rate environment.
And remember, with REITs, you get a return of capital. So what ends up happening is it's tax preferred, right, format. So quite attractive put in cash accounts.
Got it. Okay, let's go to your third pick from August of last year, Northrop Grumman on the New York Stock Exchange, 486.53 at the time, U.S., up to 592.02, 22% return, 23% total return. They do global security. Is this the kind of group that will get a lot more work moving forward?
Okay, so the U.S. defense budget was increased by 13% this year. Okay. Under the Trump presidency, I think we'll get another increase next year. And I think that the appetite for the US, particularly the Republican US segment, is for more defense spend. I think that's the first thing. So really, its big exposures are to, obviously, to the stealth bomber, the upgrade of the nuclear US arsenal, and obviously to the Star Wars programs. And so I think this is the kind of story where if you look longer term, it's just a steady dividend aristocrat type name that will continue to benefit moving forward. So it hasn't had the same kind of upside that some of the European defence contractor names have had, but they are much smaller. So if you're looking for something that's going to be anchoring your portfolio with just continuing growth, that's the kind of name you want to look at.
And they're closely tied to the U.S. government?
Oh, yeah. Well, the challenge is when doing diligence, a lot of you can't actually get a lot of detail because a lot of it's covered by national defence concerns. So a little bit difficult to diligence. But if you can pull up the long-term chart, I think it'll show viewers why it's worth taking a look at.
Okay, we're pulling that up right now so we can have a look. And you said you think the defense budget will continue to grow over the years Donald Trump is in power. There we go. So 72% up over 5 years. And fairly steady, a bit of a spike at the end of sort of 2022.
Yeah, plus the dividends as well, which tend to rise. Good management team, that's the kind of chart that you want to be owning, right?
Got it. Okay, let's take another quick break. We'll go back to your phone calls and your emails for Darren Sissons when we come back. Welcome back. Let's go to Sal on the line in Vancouver. He's got a question today for Darren. Hi, Sal.
Hi, Darren. Thanks so much. My question is on Constellation Software. I was interested to know, given how this name has been battered, similar to some of the other ones you mentioned, do you see a risk here with this name going forward? And do you think any of its spin-off companies like Lumine or Topicus might be a better choice over Constellation? Thanks so much.
Okay, so Constellation tends to get a lot of its value from acquiring, does it not?
It does, yeah. And, to be honest, from 40, let's call it 49 to 44, I don't think that's a battering. To be fair, that's a flesh wound. Because if you look at the longer term chart for that name, if you've been on that name for 10 years, you've done very, very well. And we've obviously got some clients that have got that kind of exposure. And I think it IPO'd at $17. So I think the challenge that I've always had with Constellation is that it's just a continued rush to buy small companies that don't really add any value. There's no synergy here. And so what I would like to see out of Constellation is silos. And I think when you look at the spin-outs, they actually spun out some dedicated silos.
And that seems to work for them?
It's really getting rid of smaller non-core businesses. So, they're at the point where they either have to make some bigger acquisitions, or they need to do more acquisitions. And, there's the law of large numbers and things like that. So, a lot of the gains on the company have really come from the value multiple expansion. So if you look at, for example, what's the PE on Accenture or Adobe or Salesforce? We've talked about these in the companies versus Constellation. Constellation trades at a huge premium relative to those companies, right? So I just from a risk management point of view, I just don't want to wear a trade that comes down. We should have owned it a long time ago, but I'm not buying at these levels.
Got it. Okay, let's go to Peter on the line from London, Ontario. Hi, Peter.
Hi there.
What's your question today?
Darren.
Hey.
I bought L'Oreal quite a while ago, and it's done nothing. In fact, the whole sector seems to be suffering. I'm wondering if there's any hope in its being revitalized, or should I just sell it? Thank you, Darren.
Okay, let's have a look at L'Oreal. We'll pull up the chart in a while. So this is, it's discretionary, right? This is a kind of thing that would fall under discretionary. And so maybe there's a scale back in people putting money into this with worries about the economy. Do you read it that way at all?
So I have two daughters and a wife, and I wouldn't say it's discretionary in my household.
Not for them, yes.
Not for them. Look, it's been a very well-run company for a long period of time, and it has actually had a fairly excellent performance. But I think what you've seen really is, since we transitioned into the Trump 2.0 presidency, a lot of the luxury names have been hammered. So, Louis Vuitton's down a little bit, Hermes is flat, L'Oreal's down a little bit. But I think that when you look at it in the context, yes, they are somewhat discretionary categories, but they cater to portions of the economy that is fairly resilient, right? And so what I would say is if you don't like the particular name or don't like the exposure, perhaps you can sell it. But if you're looking for a better longer term environment, then Hermes is probably the better name because it caters to the ultra wealthy, and they don't tend to suffer in recessions. But even so, if the economy is going to be weak, it's going to be weak for everybody, and all the sectors are going to suffer. So that's I think one of the challenges. You've got tech, AI tech that is just booming, and everything else is suffering.
Yeah.
And that just does not make fundamental sense.
Do you think that we're beginning to see a widening out lately? People are sort of pulling from tech, and I'm wondering if you're seeing other sectors now getting a little bit of a bounce from that money.
Well, I think one of the interesting sectors to look at is why is tobacco, after so many years, now getting a bid? I think that's a very interesting category. You're also seeing some of the staples are getting a little bit of a bid as well. I think there is some rotation around the margins, but if you're running index money and you have to care about what the indexes are doing, you cannot abandon the tech exposure because that's where all the growth is coming from. So yes, I think it will continue at the margin, but if we do see the pros come back in October and say, okay, look, I think the US budget deficit has gone too far. There's obviously too much money in one sector, and you start to see some more rotation. That rotation could happen quite quickly. But we need some kind of catalyst here.
Got it. Okay, let's go back to an email from Ian. Ian says, Meta recently had another blowout earnings report, and the stock has moved higher on the news. Would you continue to add at these levels? The PE of 27 still seems reasonable given the growth. So let's have a look. So it's pulled back a little bit, but it's 752.50. Would you invest at this level for Meta?
So again, if you're an index investor and you're following the indexes, you've got to be in all the Mag 7, right? So we have some exposure to that broader category. We don't own Meta itself. Obviously, that kind of correction is not significant. And 27 times, I remember when 20 times was significant. So 27 times, I think it's a little elevated. If we see come October a correction more meaningfully, perhaps like what we see sort of in April, down to 600, you might want to take a closer look at it. Yeah, like recessions give you opportunities to add quality. I'm not saying we're getting a recession, but the rest of the world is currently bathing in recession. The US is not, and definitely large cap tech is not. So, if the market gives you an opportunity, definitely
keep some cash on hand. Got it. All right. We are going to take another quick break. Darren Sissons of Campbell, Lee and Ross Investment Management taking your questions today on global and technology stocks. Here is how to email us and phone us. We're back in a moment. Welcome back. Let's go to an email from Francis. He wants to know about Marvell. He says, what do you think of the stock and its growth potential? Marvell also in the space, just wondering what you think of Marvell Technology. Are they software?
They're a semiconductor company.
Semiconductors.
Yeah, well, they're a design house that gets their chips manufactured there. So, I think this is an interesting story. So if you look at sort of the November, December, it was very strong last year. Obviously the dip into April, and it hasn't really recovered, really. And so, I think the issue is perhaps the smaller semiconductor companies are not getting the same level of inflows that you're starting to get, for example, with Nvidia, Applied Materials and names like that, the larger portions of the ETF market. And that may talk to some level of rotation. So I wouldn't say this is my favorite name here. As I mentioned earlier, Click, I think, is a much better opportunity. Given the pricing levels, and it's really the same trade. So if, for example, you get an increase in volumes, it's going to benefit everybody, right? So I would probably not buy Marvell here. I think it's kind of half pregnant. It's kind of half up, half down. So for that point, I would probably just pass on it. But 92% up in 5 years, it's fairly attractive.
Okay. Let's go to Harry on the line. He's in St. John, New Brunswick. Hi, Harry.
Yeah, hi there. I wonder if your guest would give me his personal feelings on Tencent. The symbol is TCEHY. About 4.5 years ago, it was a $100 stock, and as we speak, it's 78. Does he think it's going to return to that level? And what's his feeling on Chinese tech stocks in general, if he has a comment there? Thank you.
Okay, so this is a holding company. They do a number of different things, music, websites, e-commerce, mobile, gaming. Do you know much about them?
Yep, we used to own them. We used to own them, and we did actually sell it. And the reason is the Chinese market for a period there became largely uninvestable. And also the challenge is that given that you've got it listed in the US, I think that's the list, based on the symbol that you just noted, there is the risk that it could be delisted, because remember when Trump's first term, he delisted all the Chinese telecoms. So you've got a lot of political risk over the top of the Chinese companies, and then you've got some of the issues, similar levels of newsline headline risk and governance risk, and I'm talking regulatory, also is happening in China that's happened in the US. So it's problematic. I think the valuation relative to US tech is actually very attractive. But you have to hold your nose in terms of the politics. And when I'm talking the geopolitics and also the domestic Chinese politics. If you have an appetite for that, then I think that it's been a very well-run company. It's done and the fundamentals are fundamentally different from a performance perspective relative to what the stock market is when you compare it to US large cap peers. Okay. So the question becomes, is it a trade or is it an own? And I'm not convinced that Chinese names are an own at this point. I think they're a trade, so you've got to buy them inexpensively, and then you can hold them. And like earlier in the year, I think, well, late last year, I think we had a big move up in FXI, which was the Chinese ETF. So you want to look for opportunities, but you have to be mindful of the risks. So we wouldn't be buyers of Tencent here.
Got it. Okay, let's go to an email from Colin. He wants to know about BHP and just says simply your opinion, please, on BHP.
Yeah. So I would say, look, this is the best of breed miner. Largest, it's the super daddy, right? It's the big one. And at this level, I think it's $55. It's kind of half. Again, I'll use the term half pregnant, half not. Below $50, I think it's very inexpensive. But not that long ago, it was over 70. And so, we do own this name. When it tends to go below 50, we tend to buy more. When it goes up towards the 70 range, we tend to trim it. But we tend to have a fairly consistent position over time. The demand for commodities in general looks fairly weak. So in the context of you make money when you buy, I think that's an interesting category. And I think there's also a disconnect with precious metals relative to more, let's call it industrial metals. And so you've got companies like Franco-Nevada, which have had a fabulous run, gold, obviously, and the other commodities are lagging. So here, I think, this is a name where you can buy it and you can make, as you can see, has some very big spikes. So when you buy it correctly, you can make some very good money.
Did want to ask you about energy as well, because you alluded to the fact that you think the demand for energy for the AI build-out is not really going to match up with what people think it's going to be. We're all talking about the need of those data build-out centers and the need for energy, but you think perhaps the optimism for that sector is a little too high?
Well, I think, I think the fundamental flaw in the AI thinking is that all the logic, all the benefit is going to accrue to the chip companies and the processing. But I think, think about it. What are the obvious things where AI would have benefit? For example, insurance for deciding who's a good driver, who's not a bad driver, just a
evaluation of whether or not to insure somebody.
And then also, for example, if you've got a significant large data pool, big data, in terms of health, what people are going to have precursors for cancer, drug discovery and development. I think there's huge applications there. I think things like driverless cars, yeah, okay, but that's a nice to have. But what fundamentally would people pay for? Like, would you pay to know that if you ate certain foods, that would reduce your ability to get cancer? People would 100% pay for that. Right? So that's where I think the big applications for AI are really going to come. And that's a software driven. It's not going to come at the chip level. So the chip is just, let's call it just a big motor. It's just going to just whirl away. But the actual, the thought processes and the decisions that are going to come through, the models, they come at the software level. That is what people are going to really pay for.
And you think people are sort of not just seeing that yet? They can't see past the chip making?
Well, I think the problem is, if you talk, like, for example, Accenture talk about it in their calls, they're not seeing a lot of income from AI applications, and that's at the software level. Every company has got an AI offering, but what are they doing? You've got, maybe it's a chat bot, or maybe it's a small tool, but it's not fundamentally driving 10% or 20% of revenue for companies. It's just generally not. And I'm not talking the companies that are AI, I'm talking about the companies that are actually, like, for example, does Bank of Nova Scotia use AI to credit score all its new client mortgages? No, they're not.
So maybe they just haven't rolled things out yet or found where it is applicable for them?
That's the thing. It could take, if you think about the dot-com era and how that evolved, it took 15 years for everyone to do buying online, and it was really to use venture capital language, the crossing of the chasm was everyone was at home during COVID buying online, and everyone's reticence to buy online disappeared, and then we had a huge global spike in buying online. But that was a long period from 2000 to 2020. The promise and the execution, it takes a long time.
The consumer has to benefit somehow to drive the business. Okay, we're going to take a quick break. We will go through new picks from Darren when we come back. Stay tuned. Join us tomorrow on Market Call. Keith Richards on the show. He is President and Chief Portfolio Manager at Value Trend Wealth Management. He'll take your questions on technical analysis. That's tomorrow. And if you miss Market Call, check out our daily podcast. You can find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for new top picks from Darren Sissons. We're going to start with Novo Nordisk, which has been battered like many of the pharma stocks this year so far. Now, there's a lot of optimism around their drugs that help people with diabetes, but also prove to be sort of weight loss drugs. And they were developing an oral pill instead of an injection for that. Yeah. How's that going?
Yeah, so as you can see, last year it was the biggest company in Europe, and then headline risk because the two major companies in the space are Eli Lilly and Novo Nordisk. And Eli Lilly apparently had a better news on an oral drug. And then just a couple of weeks ago, that data was presented again on a more full-scale study, and it was inferior to the Novo, so the stock rebounded. And there's also a view that Zepbound, which is the Lilly product, is obviously superior to Wegovy, which again, that's kind of nonsense. So, the issue is both companies are growing at double digits in the space. Both companies are growing, the market is growing at double digits. One is trading at I think from memory, 53 times. The other's trading at 16. So in classic street language, you go short Lilly, long Novo. But, at these levels, we've owned Novo for 9 years. So we've trimmed it 7 times in 9 years. And this is the first time we've actually bought more across the board as a block. So we think there's upside here. And we don't think obesity is going away. Diabetes is definitely not going away. It's still a growth market. So we think there's, it's a good story longer term.
There's still growth in these markets outside of North America. Is that what you're thinking?
There's growth everywhere. Unfortunately, we have obesity, type 2 diabetes problems everywhere. So you've got in Europe. So Lilly tends to be more US focused. Novo tends to be more international. So, but having said that, you've got people with obesity problems in New Zealand, Australia, Europe, Germany, China, Japanese have got problems. Unfortunately, the modern life is sitting in his chair and working in a computer, and that doesn't sort of bode well for non-obesity outcomes.
Doesn't do anyone any good. Okay, so Novo Nordisk is your first top pick. Let's go to your second, Tourmaline Oil, a TOU on the TSX. You like the dividend for this one, but also LNG, which a lot of people are looking forward to, distribution getting online in Canada, and natural gas. They're hoping for natural gas expansion, but energy prices aren't helping at all.
Yeah, so the issue really here is LNG Canada, which is the export facility on the West Coast, is really it's a catalyst for Tourmaline. It's enabling the company to export to premium price markets and not take the Canadian discount relative to just shipping to a single source US supplier. So it's creating moral hazard in terms of pricing. If the US buyers don't play ball, it can go, our resources can go internationally. And I think that's positive. There is a step up in an expansion of the LNG Canada facility, doubling the capacity. You've got share buybacks, special dividends, and a sustainable dividend. So, at these levels, I think it's an interesting company, and I think that the market's starting to agree with that. And I think if you look through near-term energy weakness, picking up quality companies at inexpensive prices is really the strategy that you should be embracing.
Natural gas, what international markets are open to getting the Canadian product? Is it China? Is it Europe?
Korea, Japan, there's the appetite for energy has not declined. In fact, if anything, it continues to increase. And then if you want to fire electrons and you don't have the hydro dams, things like that we have in this country, then you have to find a way, whether it be coal, natural gas, or alternative forms, wind power. And that's what's happening. So Europe, I would be very surprised if Carney, when he was talking to the Germans this week, was not mentioning our natural gas capabilities.
Got it. Okay, let's get to your third pick then, which is Visa on the New York Stock Exchange. Visa, of course. Do you like Visa over MasterCard, some of the others in the space? And are you worried about sort of cryptocurrency, perhaps, as payment form in the future?
Yeah, so, the company's grown its dividend 23% per annum for the last 15 years. A lot of good things. But I think one of the things that attracts me here, and we've owned this for a long period of time in the firm, and we've done very well, obviously sitting on the house's money in many cases. But I think the concept of an inflation carry trade. So I'm of the view that printing in the US is continuing to create inflation. Whether the central banks want to recognize that, but the living experience of going to restaurants, going to buy anything, the theatre, prices are continuing to rise. And companies like Visa will continue to take a larger portion moving forward. So that's very positive for the company. Relative to Visa, to MasterCard, it's probably got the number one entrenched position in most markets. It's got exposure to China. MasterCard is an excellent company as well. We just happen to own Visa, and we think it's obviously a larger company. The acquisition of Visa Europe was a game changer relative to MasterCard, but both are quality companies.
Got it. Okay, we do have to leave it there. Darren, thanks for coming in. Appreciate seeing you.
Thanks for having me.
And thank you for watching Market Call with us today. We will see you again tomorrow.